Welcome to our deep dive on saving versus investing for young adults. First, we will set the stage for why this decision matters and how it shapes your path to financial freedom. Next, we will outline the agenda so you know exactly what to expect throughout this video. To begin, here is our roadmap. First, we will explore human capital and why investing in yourself can dominate your returns early on. Then, we will cover a save first, then invest strategy, followed by when to pivot into more aggressive investing. After that, we will walk through practical steps and frameworks. Next, we will test your understanding with quick quizzes. Finally, we will wrap with key takeaways and an action plan. Before we proceed, a quick but important disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Everyone's situation is different, so consult a qualified professional to tailor decisions to your circumstances. Now, with that context in place, let's move into the core idea driving early financial success: human capital. Now that the groundwork is set, let's focus on human capital. Early in your career, the biggest potential return frequently comes from increasing your earning power, not from squeezing a few extra points out of the stock market. Improving skills, obtaining certifications, or completing specialized training, even low-cost options, can significantly increase future salary and opportunities. Consequently, funding these opportunities often takes precedence because the compounding effect of higher income can outweigh small market gains. With that understanding, let's detail concrete ways to invest in yourself. Next, let's translate the human capital idea into action. First, level up with targeted, low-cost courses and certifications that align with roles you want. Second, practice negotiation to improve salary, bonuses, and raises over time. Third, build a network through mentorship, meetups, and professional groups to access opportunities faster. Fourth, create side projects or a portfolio to demonstrate your capabilities. Tangible proof often accelerates hiring decisions. Finally, track return on investment by comparing the cost of training with the potential income increase over 1 to 3 years. This disciplined approach can unlock a higher salary trajectory, compounding your financial progress. Now let's anchor your money strategy with a save-first framework before you expand into investing. Moving on. The sequence matters. First, eliminate high-interest debt such as credit cards, because their interest charges can erase investment gains. Pay more than minimums until those balances are gone. Second, establish an emergency fund covering 3 to 6 months of expenses in a safe, accessible account. This buffer reduces stress and prevents new debt when life happens. Third, for short-term goals under 3 years, such as tuition or a planned move, keep that money liquid and stable, typically in a high-yield savings account. Once these foundations are set, you can pivot to diversified investing with confidence. To help you build that buffer, let's walk through practical steps to set up the emergency fund. Then, to set up your emergency fund, start by calculating your essential monthly costs, including rent, food, transportation, insurance, and minimum debt payments. Next, choose a target of 3 to 6 months of expenses depending on your job stability and comfort with risk. After that, open a separate high-yield savings account to keep this money distinct from spending. Automate transfers on each payday to steadily build the fund. Finally, if you ever draw from the emergency fund, make refilling it your first priority before adding to new investments. Now, let's check your understanding with a quick quiz. Quick knowledge check. The question is, what should be your absolute first priority when starting out? The options are paying off high-interest debt, investing aggressively, buying a new car, timing the market. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is paying off high-interest debt. This is because compounding interest on expensive debt can overwhelm typical investment returns, making it very hard to get ahead. Eliminating it first protects your progress and sets a strong foundation for saving and investing. Next, once your debt is eliminated and your emergency fund and short-term goals are covered, excess cash sitting in low-yield accounts can lose purchasing power to inflation. At this point, deploy surpluses into diversified, low-cost index funds. If your expenses are minimal and your time horizon spans decades, an aggressive allocation, such as allocating 50 to 75% of future surplus to the market, can be reasonable, provided your safety buffers remain intact. Automate contributions, and use dollar-cost averaging to smooth market volatility. Finally, reassess your allocations after major life events like a new job, relocation, or adding dependents to ensure your strategy still matches your risk and goals. To see the trade-offs more clearly, let's compare saving and investing side by side. After understanding the pivot, it helps to compare saving and investing. Saving focuses on stability and liquidity, making it ideal for emergencies and goals under 3 years. Risk is low, but returns are modest, and inflation can slowly reduce purchasing power. Accounts, such as high-yield savings, certificates of deposit, or money market accounts, are suitable. Investing, in contrast, targets long-term growth over 5 to 30 or more years. While it carries market volatility, it offers higher return potential. Low-cost index funds and tax-advantaged accounts are common vehicles. However, investing requires tolerance for short-term swings and a disciplined mindset to stay the course. Now let's visualize a possible 10-year trajectory. In the first year, focus on eliminating high-interest debt, building a 3 to 6 month emergency fund, and beginning low-cost upskilling. From years 1 to 3, continue skill development, negotiate raises, and start dollar-cost averaging into broad index funds while keeping short-term goal funds liquid. From years 3 to 7, increase your investing rate toward 50 to 75% of future surplus, and pursue promotions or higher-paying roles, including contributions to tax-advantaged accounts where applicable. From years 7 to 10, maintain your safety buffers, diversify across asset classes as appropriate, refine long-term goals, and keep learning to sustain income growth. This progression demonstrates how foundation, growth, and resilience come together over time. Next, consider some quick math to illustrate priorities. With a credit card charging around 22% interest and an expected market return of roughly 7%, the net effect is negative 15%, implying you should pay that debt first. A personal loan at 10% still exceeds expected returns, again suggesting debt payoff before investing. Conversely, a student loan at 4% is below the expected return, so allocating to investments may be reasonable once buffers are in place and payments are under control. Your exact numbers will differ, so assess your own rates and risks. Here is your second knowledge check. The question is, which choice is most likely to deliver the highest return on investment early in your career? The options are: mastering salary negotiation and in-demand skills, picking individual stocks, waiting for the perfect time to invest, keeping all money in checking. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is mastering salary negotiation and in-demand skills. Increasing your income potential expands your investable surplus and compounds your progress, often outpacing what early market gains alone can provide. Stock picking, market timing, or holding cash typically do less for your long-term trajectory compared to sustained income growth paired with disciplined investing. Before we wrap, here are the key takeaways. First, eliminate high-interest debt. Second, build a 3 to 6 month emergency fund. Third, keep short-term goals liquid. Fourth, invest in yourself to increase earning power. Fifth, once the foundation is secure, automate diversified, low-cost investing. Finally, prioritize consistency over perfect timing. Finally, let's bring it all together. Adopt a zero-tolerance stance on high-interest debt. Secure liquidity with an emergency fund before chasing growth. Invest in skills and negotiate your value. Use dollar-cost averaging into low-cost, diversified index funds. Revisit your plan after major life changes. Start small and remain consistent so time and compounding can work in your favor. With this mindset, you can move confidently toward financial freedom. Thank you for watching. If you found this helpful, please like the video, share it with a friend, and subscribe for more content. In the comments, tell us how you plan to balance saving and investing this year. Your insights might help someone else on their journey.